Debt spiral.
In it.
Janet Yellen.
Retire.
Jerome Powell.
Should be retired. Oh, sorry. One word. You know what? Honestly, the word that really does come into mind for Powell is pickle.
The Bitcoin ETFs.
Oh, money.
Hyper Bitcoinization.
Soon.
Women in Bitcoin.
Needed.
Mr. James Lavish, thank you so much for coming on to the show today. I'm Playable Character Show. I joke with everybody that we're in a sea of non-playable characters, so we're always trying to find the ones who can critically think and actually put forth an effort, I guess, when it comes to thinking. So thank you for coming on the show today, brother.
Yeah, of course. Great to be here, Brandon. Happy to talk to you.
So for those who don't know James, just a little bit, he's reading from his Twitter bio, which actually I'll share here, formed hedge fund manager, played hockey at Yale. So we're kindred spirits in that regard, playing college hockey, drafted by the Bruins, landed on Wall Street. So very, very interesting background, and the author of the Informationist Newsletter, which is a phenomenal letter. And I have talked to many Bitcoiners, just that read your letter and really truly simplifying things for all. And also you are, correct me if I'm wrong, but you're a GP, a general partner with the Bitcoin Opportunity Fund as well, which we'll touch on here as well. So just a little background on that.
That's right. So I'm a co-managing partner with David Foley on the Bitcoin Opportunity Fund, and we are actively investing, and we just closed our capital raise, so we're pretty excited. It's been a fun ride for the last year and a half. So, but this is we're in a tremendous opportunity in my opinion. So it's good.
Incredible. Well, we can touch on that a little bit. I was telling you off stage, I want to kind of just get the lay of the land from you. Like I was telling you, I was talking to some of the other fellas earlier this week and asking, some pointed questions, but I wanted to kind of just maybe let you riff for a few minutes and just kind of like, what's keeping you up at night? What are you thinking about? Could be Bitcoin, could be macro, could be the United States government, could be, economic malaise, the crazy things you see on social media and rioting, protesting, people beating each other up, not on the hockey rink. So people just in the streets, kids, just craziness, kind of social decay everywhere. I mean, what's keeping James Lavish up at night right now?
Well, okay, that's a lot of vectors to touch on, but I try to avoid the noise as much as I can. It's not easy. I will admit, especially on Twitter X, you have this constant stream of social consciousness, and so I do try to avoid that. When I see some stuff that's super disturbing, I just say not interested, and hopefully the algorithm picks up on that sooner or later. But what is keeping me up at night, truly, honestly, is my excitement about Bitcoin right now. And that's truthful. I am not, my portfolios, personal portfolios, the ones that I share in my paid group for the Informationist, that I feel super well positioned for anything that happens here, whether we have a melt up or we have a meltdown. I feel like I'm protected. I'm not worried about my personal portfolios. I'm excited, super excited about Bitcoin and the opportunities here. And I mean, these ETFs have unlocked a tremendous amount of capital. So when, if what has been on my mind that's not keeping me up, that's keeping me stimulated, and I'm really been focused on, is just a sheer wall of capital that is starting to trickle in. It's not even like we have not been hit with the tsunami yet. I even posted about it last night, and that wasn't tongue in cheek. I'm being dead serious that this is going to take a while. It's going to continue to grow and gain momentum, and that doesn't mean that we won't have volatility. I'm trying to make sure that people understand and are tempered in their enthusiasm. As enthusiastic as I am, I still expect Bitcoin to be volatile. It's normal for this asset. It's a growing asset. It's still nascent. I mean, we're not even 15 years in here, and so it's starting to gain that mass. Uh, it's not even momentum. It's just this the understanding, the the desire to understand it is growing. So let's put it that way. But with the ETFs, what's been so important about that is, and I've talked about this so many times, but just in a really quick recap, is, and I get this so often, like, why would people buy ETFs rather than just Bitcoin itself? Well, there's a lot of reasons. Number one being the institutions just can't buy that. They just can't buy Bitcoin in a way that would suffice their compliance and their fiduciary duties. No portfolio manager from a big pension fund wants to be holding keys to Bitcoin, particularly not if you're managing hundreds of billions of dollars. You don't want to be holding keys to $1 billion of Bitcoin. Nobody wants to do that. So, and even if you did, you're not going to get compliance to agree to that. You're going to have to go through hoops, and you're going to have to walk on coals. And the fiduciary and personal risk is just too high. So they're not doing it. And then registered investment advisors who advise clients, they actually invest money for their clients. They have not had the incentive or the ability to do so either, because of the same problems. It's not like you can just buy this and put it in a wallet for your customers. These banks, and the investment funds, they use what's called a prime broker. And this, Brandon, but for your listeners, they use a prime broker that actually custodies their assets for them. And so you would have to have a qualified custodian, and you'd have to have special agreements. Where is it going to trade? Is that an exchange that's has oversight from the SEC? How is it going to settle? Who's going to settle? There's just a litany of answers, questions that have to be answered, and problems have to be solved. Now, and as for the other people, why would an individual buy the ETF? Well, because they don't feel comfortable buying a signing device, what we call wallets. They're actually signing devices, and having that risk. I mean, I'm going to admit, just a few years ago, I did it for the first time. It was nervy for me. I mean, I was like, where is this? How do I know it's settled? And I'm not, at my age, I wouldn't call myself a tech savant, but I'm tech savvy enough. I come from the BlackBerry world, so I'm used to tech. And so, but even for me, it was uncomfortable a little bit. Get me outside my comfort zone. Can you imagine someone who's in their 40s, 50s, 60s, 70s who are using a signing device? Like, that just doesn't sound like it's something they want to do. Now, flash forward. Suddenly we have these ETFs that have splashed onto the stage, and you've got this super highway that's built. So it's they're not stocks. They're basically trusts. They're funds, but they own underlying Bitcoin in them, and that's supposed to match the amount of money that people have bought those shares for on these exchanges. So, and it's pretty simple though. Those ETFs own the underlying Bitcoin, and the individuals who are buying that can buy it through their broker, their trading exchange. You can settle it with your prime broker if you're an institution. They can custody it. It's a same settlement process and DTC process for you putting margin on it or whatever you're doing with your regular trade. It certainly requires more margin than something that's a mainstay stock, like an Apple or something. But
Mm-hmm.
you don't have any of those settlement issues. You don't have any of those custody issues. You know exactly where it's going to be marked. You know how it's going to be custodied, and you don't have to have a special process that's designed by your chief compliance officer, by your general counsel. You just buy it and settle it just like a regular stock. It's super easy. Now, all that said, why have we not seen just a wall of capital, right? We're seeing this, not a trickle, but a solid stream of capital coming in every single day. Larry Lepard had retweeted something this morning that should just the sheer, I think it was from Bitcoin Archive from Archie, where it's just this steady stream of capital comes in every single day, somewhere between a billion and $1 billion that are coming into these ETFs. That's new money coming into the space every single day. It's not a wall of capital, but what you're seeing is these on-ramps are being built where you've got these registered investment advisors, the brokers, the institutions, the family offices. They've gotten their compliance in place. They've gotten their pamphlet in place. They can, make their investors aware of the risks, and they can have the check the box and go ahead and buy it and settle it just like a regular stock now. And it's starting to happen across the board, but it's happening steadily but slowly. And that's why I said last night that it's still not priced in. The amount of capital that's going to come into this space is magnitudes of multiples of what we've seen so far, and it's going to be over the course of months, and perhaps even longer. So that is a long answer to what has been on my mind, but
We want to thank our sponsor. This show is presented by Bitcoin Trading Cards, an orange pill in a pack, making talking about things that normally make you want to cry fun and easy. The scarcest and most educational cards to ever exist, available now.
truly that's been my focus recently.
Well, I'm glad that I started with that, because yes, there's a lot on your mind, as with many Bitcoiners, and that's probably how a lot of the shows in a way should start, I guess, is, what is on your mind, what's going, is, as Bitcoiners, there's always a lot on a Bitcoiner's mind. So I appreciate you sharing that. How do you, it makes me think of a few things, like you said, the wall of cash. It's inconceivable, the wall of cash, the amount of cash. It's not in Bitcoin, obviously. It's all out into other assets. It's around emerging markets, you name it, real estate, bond market. It's really, you can't even fathom you can't wrap your head around it. And then you have Larry, like I was saying earlier, I was talking to Larry the other day too, and he was talking about the ETF multiplier, right? Where you have these effects of just this, like you said, the amount that you just laid out coming in, but the multiples of the increase of the price, the fiat price for a Bitcoin, have just been exploding, or, in the market cap growing, I guess is probably the better way to look at it. It's mind blowing. And then that's a small move, really. It's right. There's a small amount that's come in so far of the world, liquidity. It's wild.
So let's unpack that. So first of all, the multiplier, right? So if you step into the marketplace and there are no offers for Bitcoin between here and 100,000, say, there's just no offers. There, you look at the book and there's nothing offered there. You could buy $1 of Bitcoin at $100,000 price, and that takes that market cap all the way up to that. Now everybody's made that paper gain because there was just no liquidity, and that's what you're seeing here. You're seeing more buying demand than selling demand. It sounds super simple and stupid, but that's exactly what it is. It's just that there's been pockets of illiquidity, and those pockets are closing on the way up. So even though we've had, call it $10 billion net come in, the GBTC selling has been absorbed by mostly by the other ETFs. And then the additional capital has come in is about $10 trillion ish. It's closer probably to 12 now, but let's call it that. But the point is that Bitcoin has risen by hundreds of billions of dollars in market value since the launch of these ETFs. So the multiplier is somewhere north of, I did it a few days ago, it was north of 40, 45, I think it was. So,
Jeez.
But,
it was 37
now,
on Monday. So now it's,
so,
and now here we are 2 days later. It's wild.
So and it'll settle down, as we get higher in price, we get more, it will settle down. And remember, you're just looking at the ETFs there. So the multiplier is probably lower than that, So, but net, that's what's happening on the multiplier side. Now, the amount of capital that's out there. So if you step back, Brandon, and you look at the investable assets in the world, right? The biggest thing in the world is real estate, right? So you've got your residential real estate is at $500 trillion. You've got commercial real estate, which is about 115 or 120. You've got bonds, which are about 130 trillion. You've got stocks around the world, which are 110, 115. It's fluctuating. You've got about $90 trillion of just cash and equivalents out there. And then you've got gold, which is about 10 trillion. And then all the way at the bottom there, you've got Bitcoin, which is about 1 trillion. And you could add in things like art and collectibles for another 20 or 30 trillion. But that you're talking about somewhere about 950 trillion to $1 quadrillion of assets out there, investable assets. And Bitcoin is making up just it's tiny. It's 0.1% of the total, you know. So now when you let's dig in, let's just drill in a little bit deeper, right? So I posted something earlier this week again about Bitcoin had climbed up to the 8th largest asset in the world. It just toppled silver.
So,
And you've got things up there like Saudi Aramco, you know, you've got Apple and Microsoft and Google and so and Nvidia. Like these are massive assets, but those are in that stock, that's $110 trillion
stock
of
market.
stock bucket.
Yeah.
Um, so, but the point is that we'll start to see reallocation out of things like stocks and gold. We've seen the ETFs have been bleeding in gold. And so that's been interesting. But then also, you've got people who buy real estate just for long-term investments. And so that might be a bucket that starts to bleed into here. But the first bucket that's going to bleed in there is from these pension funds, from the institutions, the endowments that are saying, okay, I need to have a 0.5% or 1% allocation to Bitcoin. And now we're seeing BlackRock putting it into their funds. So it's an ETF that's being put into their big ETF fund that has a number of different assets, but they're going to allocate it in there. So now you're going to have people who own the BlackRock asset. That's a BlackRock equity bond fund or whatever. And then that's going to be an allocation in there. So you'll have people don't even realize that they own Bitcoin, but it's part of the allocation of this bigger fund. So when you look at BlackRock with somewhere around $10 trillion of assets, you know, so if they make just 1%, I mean, 1% position allocation across the board, that's a massive amount for that one institution. So, and they're just one institution. They're one of, if not the largest, but they're right up there in the top 2 or 3. But you know, this is what you're going to start to see. Now, lastly, so unpacking this further, which will tie us back to that multiplier effect. When you're an institution, and I've sat in this seat for many years, and you need an allocation of something, you're not really price sensitive. You know, you're not looking at it and going, oh, well, it's up 3% today. You're not doing that. You're saying, well, I need 1% in my portfolio. So you get the amount you need, the $100 million, and you call up your broker or you talk to your sales trader on the other side, Morgan Stanley or Goldman Sachs. You say, I need to buy $100,000 of Bitcoin today. So go in there and buy, you know, FBTC or IBIT, just participate. And so they just participate along with the rest of the volume. They may end up driving volume, but it's called volume weighted average price, the VWAP. They just want to participate. And they're not sitting there saying, oh, well, we're going to wait until it comes back to 63,000. They're just like, well, we need to buy it. Buy it. And then when you're done, we're going to have 100 million more. And when you're done with that, we're going to have $100 million more. And then when you're done with that, we're going to have $100 million more. And it's literally, this is just what's happening. And this is going to happen in perpetuity, not in perpetuity, but for, I can see a foreseeable future, whether it's the next number of weeks, the next number of months, but that's just the function and the way that Wall Street works, the way that institutional investing works. Now, Lastly, this is all holding all else equal. We haven't even talked about interest rates, the Fed, what's going on in
Yeah.
the deficits, and with the overall markets. Those can have an impact, certainly, to an asset like Bitcoin, as we've seen. So, holding everything else equal, we're just in this period of, well, looks like we're gonna have this beautiful soft landing. This is what's happening.
It's wild. It's absolutely wild. What really quickly on the so some of the ETF stuff. I know this is a question that will come up. Like it comes up in spaces a lot, or like you conferences, or people will be thinking, or just chatter. How does how are the ETFs settled? I guess is it cash settled? I'm assuming it is cash settled. I'm not positive on.
This is a big thing. Yeah, this is a big thing. I think with the SEC is they didn't want investors to be able to redeem. So there's two things. They didn't want the investors to be able to redeem their FBTC or IBIT or whatever the other,
Yeah.
they didn't want to say, well, I want Bitcoin. So they're going to be cash settled, cash redeemable. That's it. Okay. So that was a big thing. How are they buying Bitcoin throughout the day is probably what your real question is. And this is
Yeah.
confusing.
How do we make sure that they
So
are buying it? Or for the person that, yeah.
no, they
Okay.
are. So what's happening is you have approved participants, and they what they do is they're out there. These are professional traders, market makers. They're making the market in the different ETFs.
Mm-hmm.
And as people are buying, well, they're hedging that. They're going out and buying futures or options or whatever they need to do to hedge it while they need. So then at the end of the trading day, they settle out, okay, this is how much we need to buy. I'm hedged 100% on that. So you're going to see
Mm-hmm.
the Bitcoin price move throughout the day according to the price of the activity in the market. It's not like people are buying in the day and then overnight it jumps because they had to buy overnight, and then they buy it during the day and then overnight it jumps again. That's not the way they're settling it, and they're settling this, or they're filling those trades throughout the day. They're hedging them throughout the day, and then they're going to match up and swap. Basically, they have one big block trade uh, after hours or the next morning, where they settle it with the ETF, and the ETF is buying and they're selling, and then they're clean, and then that's it. So, but that's what's happening essentially.
Is is the market, I guess I don't even know how this is done either. I mean, obviously, back in the day, I don't know if it was like this when you started in Wall Street or if you had already missed it. But when guys are in the pit and right, you're trading back and forth and you're making deals, you're settling stuff there. How is it algorithmic now? Is it computers that are ones market making and selling? Are there guys doing it? Like, how is this and how is this pertain to the Bitcoin part of this? Where how are these markets being made
All the
and
above.
this price? This,
All the above. I mean, they're using every single tool they have at their disposal, that they're hedging it, and fair disclosure, I have not traded in many years. I've been managing portfolios and had other people trading. So these trading tools have gotten highly sophisticated, and when I say just participate or be on the VWAP, I've got old school traders who can do it, by instinct, but then you've
wow,
got other people that just put it in this computer program and it does it automatically. So it's all of the above.
wow, that's wild. Is there any way to again, making sure, obviously in the Bitcoin world, it's not your keys, not your coins, like you said, but there's a huge segment of society where the ETFs are that kind of first foray. It makes it easier for people to get into it. How do you make sure we're sending cash to Ukraine and the politicians are like, well, we don't need the amendment to audit the cash. How do
Yeah.
how do we audit the ETFs? I mean, I know you get some that, like Joe Calasaro, will say, well, that's the rules. Like it's a contract. They have to audit it. It's there. I
Yeah.
tend to disagree. I don't trust the government that much, or entities inside there. How are you making sure? How are we making sure that those purchases are happening?
Well, some of them are actually posting the addresses that have the Bitcoin in them, so we know that. The other ones are using approved auditors. You've got oversight from the SEC. It's in BlackRock's interest to own the Bitcoin. they're making fees off this. It's not like this is not going to be my opinion is that this is not going to be the rug. This is not going to be the rug pull of the century. They're in the business of making money. They're not in the business
Mhm.
of scamming people. And in order to do that, they need to uphold their agreement. I'm with Joe Carlasare on this, that this is, this is the way that it's structured and the way it works. It's just like Apple. How do you know that your custodian is actually owning Apple? I
Absolutely.
mean, look, this is not Bernie Madoff where he just lied about it and told his investors he was doing all these things, and the auditors just kind of glanced right past it and just signed off on it and went out to dinner instead, which was it's an incredible story. But this is, this involves thousands and thousands of people in these firms that you'll have dozens, if not hundreds of people who will be touching these things daily, in each firm. So this is a big deal. It, I don't see how it would have to be a systematic, collusion from the top down, including the SEC, including
Mhm.
BlackRock, including Fidelity, including like it would just, I just don't see how that could happen.
Well, it's good. Hopefully, it lends confidence to people watching, or just over time people seeing that. So that's good. Good news. Transitioning a little bit here, what are your thoughts on Groman and Preston the other day? We were talking about Warren Buffett's cash position. And again, we get it. He's 95 years old. That's probably part of what's going on. However, he's still looked at obviously as the oracle, and he's the guy. But he signifies a lot of society though, in a way, right? So you have these cash positions building and things of that nature, and it's just melting away. I mean, what in your eyes? I mean, what did Michael Saylor see that Warren Buffett doesn't see, or people like them, right? Paul Tudor Jones and Druckenmiller versus whoever on the Buffett side, right?
You can't get any more traditional old school than Warren Buffett. And
True.
I can't criticize Warren Buffett. He's made an absolute fortune in the world that he lives in the world that we've lived in institutionally, institutional investing. So what is he doing? Well, he's being paid more to sit on cash now than he has in 20 years. So why wouldn't he do that? If he thinks that there's risks to market turmoil, which I believe there are risks, absolutely, then why wouldn't he sit on that cash? He's sitting on he's not just sitting on cash that's not earning anything. He's earning somewhere north of 5%, I would imagine, on average on that cash that he's sitting on, while he waits for opportunities. If we do have market turmoil, he'll step in and take advantage of it. That's his MO. He's a
Mm-hmm.
value investor, deep value. And so he wants cash generating businesses that he can value. He can't value Bitcoin. That's the problem. He looks at it and he says, I don't know how to value that. That's not in my purview.
Yeah.
It's not on my fairway that I've made all this money all these years on. Now, I agree. He's completely wrong about Bitcoin. He and Charlie Munger have been wrong all along. But he's been right about other things,
Yeah.
to a great degree. So, is it disappointing to hear them speak so badly about it? Sure, it is. But they're not. You know, Charlie's gone.
Mm-hmm.
The timeline for Warren Buffett isn't 40 years. The
Right.
timeline, hopefully for you and me, you longer than me, is that or longer. We don't know, but that's what our hope is. And so we have a long time, and this is a long-term thesis for us. So why is he doing that? He's getting paid. Now, is it melting away? Uh, well, you and I would argue yes. Why? Because I believe that the inflation rate is closer to the expansion of the money supply rate, which is over 7% since the 1970s. And if you're only getting paid 5%, you're losing money on purchasing power. But when you look at the real rate versus what the published CPI rate is, you're getting paid. So that's that's the argument. Does he care about possibly losing 1.5% on purchasing power annually if he's going to be able to turn around and take advantage of a massive downturn or a huge opportunity somewhere? I don't think so. That's what I don't know Warren. I've never met him. I respect him greatly, but that is my guess of what he's thinking.
And cash at the end of the day is it's an option premium you're paying, right? For being nimble, I guess. And that's how he looks at it, right? Like he keeps increasing over the last 15 years. That's because he
I,
sees
I have
payoffs.
I have cash in my portfolio that's generating interest as well because I do believe that there will be pockets of opportunity here.
Mm-hmm.
And that's it's a good ballast in periods of uncertainty, and we're certainly in a period of uncertainty. Certainly in a period of uncertainty.
Yeah, oh, yeah. Well said. Are those generally in like Warren's, for example? Would he have those, whatever it is, 130 billion or 150? Are those in like 12-month like T bills, or like, what is
Probably
he? What
shorter.
would?
Probably
Okay,
3-month T-bills.
okay, even shorter duration. Yeah, just
Probably.
real short. Yeah,
Probably because, well, I mean, look, if the Fed lowers rates, then that's good. So maybe he's got a blend because he's expecting the Fed to lower
yeah,
rates. Maybe
true.
he's got to blend out too. But I would say the average maturity is probably 3 months to a year at most.
Yeah, yeah. All right, so transitioning again a little bit here, so one of the emails I get, which is a pretty funny email as well, besides yours, is the liquidity email, which is from whatever Wall Street or whatever. It's a pretty big letter, and they always have great memes in there and just stuff like that. But you know, just anecdotally from my perspective, just seeing this email every single day with just the different metrics and things like that, I've seen, I don't even know, millions of jobs. I mean, every day it seems like you count up the headlines, it's like 10,000 there, 50,000 there. I mean, this is like a year and a half, jobs just evaporating everywhere, everywhere. And I wish I would have like had a counter of just from this email of like all the jobs being lost. But then you like go out in the world and it's just like, well, everything's fine. And there's segments of society like things are fine. And then there's other segments like we were saying earlier, is societal decay. We, where is this, like, where does the rubber meet the road? Where does reality like actually set in? And I feel like we're just Bugs Bunny like flying off the cliff, or the coyote, and just we haven't looked down yet. It boggles my mind that you can have the economy seemingly like, hey, things are running. There's not total nuclear war going on, but yet just job losses everywhere for a year and a half. What do you make of that? I don't, or help me understand.
There's a few things here, and Lynn Alden goes into great detail about this, and I'll give a brief and quick overview for your listeners. And I like to keep things simple, but basically, what's happening is we've seen the Fed tighten quite a bit over the past, the last year. They've been paused since for almost 6 months now, but what happened is as the Fed has been tightening, that is restrictive. And so you're seeing pockets of the economy that are suffering from high rates. So if you're a company that it has to depend on leverage, for instance, and borrowing, then you're likely seeing your margins being compressed here because your margin of profitability being compressed because the cost of capital has gone up. And so those companies they've been unwilling to let employees go because it was so difficult to find people who will work when
Yeah.
we were coming out of the pandemic. So part of it is that waited very long. And so now you're seeing swaths of people laid off because it's like, okay, enough's enough. We can't keep up.
Okay.
So you've got that going on in one area of the economy where there are pockets of pain, and you can see it. And then on the other side, you've got this tremendous fiscal spending going on. There's just the incredible irresponsibility coming out of Washington. We're running $2 trillion deficits, which is 7% of GDP, which is just it's unbelievable. We've never done this in a period where we're not in recession. You would expect unemployment to be somewhere between 5 and 10%. for us to be running deficits like this. Yet we're doing it, and the deficits are growing. And as the interest rates stay here, and we pay more interest on our debt, and we grow our debt because of this, the continued deficits, the perpetual deficits, which requires more borrowing, which requires more interest on more debt. It's just getting worse. And so, but that is stimulative. It's a bunch of money being poured into the economy
Yeah.
in infrastructure, but like the Inflation Reduction Act is literally causing inflation. I mean, that's the whole. It's laughable that
Oh,
they.
man.
And I saw the Babylon Bee had an article yesterday, which I love. The Babylon Bee had an
So
article
good.
that the White House just went ahead and replaced the press secretary with an actual gas light. So I mean, like and it's laughable. And it's both parties. Let's be fair.
It
It's
is.
not
It is.
it's not just the Democrats. It's
Oh,
all
man.
government. But
Yeah.
it's silly. We're running these deficits, and it's stimulating pockets of the economy. And so you can see that. So you've got some people who are doing well. You've certainly got bankers who have done well and are doing well. And then you've got pockets of technology. It's not of employees that are not doing great. They're being laid off, and some of that is AI. I don't think a ton of it
Yeah.
is yet, but some of it.
Yeah.
But some of it is just enough's enough. The cost of leverage is too high. We have to start laying off people to retain the margins. So you're seeing that push and pull, and it's clear, it's obvious when you look at the screens. You look at my screens and what I'm looking at all day long. Well, the fiscal deficits are winning, and I said it on Scott Melker's show on Monday morning that it just feels like you've got Godzilla, uh, the Treasury fighting the Fed, King Kong, and Godzilla's winning. And it's kind of amazing that we're seeing this play out, and it's not really a soft landing as much as just a continued flush of capital and liquidity into the markets or into the economy. Uh,
Mhm.
that doesn't mean that there aren't people who are feeling pain. Of course they are. You're seeing defaults on credit cards with younger people rise. You're seeing defaults on mortgages, particularly with millennials, rise. Uh, there are definitely pockets of pain because people can't keep up with the payments. And now you're seeing this surge in buy now, pay later. You're seeing a surge in the amount of just the amount that people are putting on credit cards, the balances that they're carrying, and so there will be pockets of pain. It will continue. It's just a question of does it break the camel's back at some point where we see an onslaught of unemployment and job losses from it. It's hard to tell.
Wild. Yeah. And that's, the question that, it's not, no one knows, what's that straw, right? That's the answer that, hey, if someone knew the answer for what breaks it, where in the economy something will break, I guess, and then, hey, you're Nostradamus, you win the prize. But that's the question everyone asks, right? What do you think the 40-year trend of rates, we were talking about this briefly off stage, but what is your thought? Just, I guess, it could be short-term and long-term thoughts, but obviously this 40-year trend that we saw from, what was it, the 40s in essence, World War II to 1980, and then 1980 to basically now, are we really, like in this, elongated, rising rate environment going forward? I mean, what are your thoughts? They're going to try to suppress now, yield curve control, right, and do what they got to do. But what do we look like long-term? And what does the world look like in the coming years and decades here?
Yeah, barring any financial, structural, large scale incident, some sort of credit event, barring a credit event, I believe that we're going to you can see that inflation has kind of settled in around the 3% range. I've said this for a long time. I've been saying this for over a year that we will have high perpetual inflation. That's what it's going to be. That inflation is due to fiscal stimulus. That's what's going on. The deficits are creating inflation. And so as that continues and we have that 3% inflation, well, interest rates are going to stay higher. Now, that's the inflation that we're admitting to. I mean, the real inflation is closer to probably to 7%, or maybe even higher. And so we're still running rates that are stimulative. I mean, you'd have to have real rates negative to what you want is real rates to be negative in order to continue this charade, which means that you're going to allow inflation to continue on. So I don't see rates going to the Volcker era of the 80s. I don't see them going to 16, 18, 20%. But I can see rates structurally remaining higher here for a period of time as inflation continues to run a little bit hot. Does that mean that the Fed won't lower rates? No, I don't think so. I think there's tremendous pressure from the White House in particular, because and it doesn't matter again which um,
Right.
parties in
They all do it.
control. They all
Yep.
do it. They want stimulation they want the economy to be roaring before an election, even if they want to err on the side of inflation as long as it's not out of control, rather than the side of deflation or recession. So they're going to allow it to continue here, which means that we're not. I don't see the Fed raising rates. I can see them lowering them a little bit, but then inflation just becomes entrenched here, which I believe it's entrenched at 3%, 3 to 4%, somewhere in there. Maybe it becomes entrenched at 6, 7, 8%. Um, Luke, I think, believes it could get in the teens. It's going to have to, though. Inflation's going to have to get up into the teens in order to keep the debt from spiraling out of control. And that means allowing inflation to run hot without raising rates to the point where you're burdening the Treasury with too much interest cost. And then so that's kind of the push and pull there.
Man, I could go down these rabbit holes all day. This is just it's wild. What do you think that really quick? If I want to talk about the Bitcoin Opportunity Fund and the Informationist here as we kind of gather towards the end here, but do you think
Or we can
that
talk about
you always get
hockey.
yeah, exactly. We got to talk about hockey for a minute. It, 1971. I mean, there's no, at that time, the U.S. military is pretty big. I mean, it's, we were in war, but like, it was just, there's a lot going on. We have a pretty big military. There's a lot of might here at that point. So yeah, I mean, you rug pull the world of their gold. What are you going to do? Come get us, I guess. Right. So there wasn't a world war somehow. But I mean, again, how does it end at the end of the day? Like a debt jubilee, and it's just like, yeah, kumbaya. Like, sorry, we rug pulled you guys again. Like how does it work at the end of the day? I mean, these are the things that keep me up at night. Where I'm like, what? How does this end? Like, where are we going? Should I be preparing for a war? Like, what are we doing here? Like,
Yeah. That's a good. We did have an energy war when I was a kid. We did have the oil crisis, and that was painful. And so inflation was hot, and it was painful. I mean, we sat in line in my car for gas every other
wow.
week, and so just for me to get to hockey. How does it end? This could take a very long time,
Yeah.
or it could happen in a flash. I believe it takes a long time. I believe that we're on this path of just continuing to grind down other currencies and have them basically fold into ours,
Mm-hmm.
fold into the US dollar, while we just keep running these huge deficits and allow our interest rate is our the U.S. Treasury rate is higher. The 10-year is higher than rates around the world, way higher than the Japanese, the
And yeah,
JGBs,
yeah.
higher than Italy, Germany, the UK. It's higher across the board, and so that it just continues to drive money to the dollar and to the Treasury, and so this could continue for a while. And I think what happens though is that they eventually kind of lose control, and inflation gets out of control, and people lose confidence in the long-term treasuries because they're seeing how much purchasing power they're losing every single day, And so why do they want to hold something that's 10 years or longer? And as that happens, then rates are going to structurally move higher. And that's where you see it get out of control. But I think that you're going to see hints of it and an inkling of it. You could see the Treasury say, "Oh, we got to, we're going to have to issue $2 trillion this quarter. We expected $500 billion," and the bond market freak out. And you could see something close to a bond market failure, where it goes no bid. But that's where the Treasury and the Fed step in, print more, and we start the charade again. And so, that's just another step toward the inevitability of the U.S. dollar going away. And but we can't continue on this path forever. They all know it. They've all admitted to it.
Yeah.
The Treasury puts out a report every single year, and they labeled the report last year an unsustainable fiscal path. They literally labeled it for the whole world to
That's right.
see, which is a red flag to not to the world. They're trying to warn Congress. They're like, you guys got to stop spending. We can't keep pumping debt like this. And then you've got Powell said it on 60 Minutes a few weeks ago. Yellen has said it. This is unsustainable. It's unsustainable. It's unsustainable. That's the word they use. This is unsustainable. We all know it. So what do? Are they going to cut spending? No, nobody's going to cut spending. Biden just said he wants to spend $7.3 trillion starting this fiscal year. What? So that's okay. So it's political suicide. Nobody will do it. Everybody wants to spend money for their constituents. So you can do that. You can raise taxes, which he's talking about raising taxes on billionaires. And the amount that he's talking about raising is just a drop in the bucket. It's going to take, I think it takes care of 3 days of spending each year is what he's talking about. It's ridiculous. So that's not going to, raising taxes. Ultimately, if you raise taxes on companies and people, it just doesn't work. It disincentivizes productivity. It disincentivizes reinvesting back into your company and products, and so your productivity ends up contracting eventually. And so you have a higher tax rate on lower productivity. You get to the same spot. And so, or you could just keep issuing bonds, which we do. We just keep borrowing. But if you do that, you have to allow for high structural inflation, which we're also doing. And that's the path we're on. And we're just going to continue doing it until it just spirals out of control. It'd be like, whoops, helicopter blade came off and that's it.
um, really, we could go down these forever. Really quick, I want to get just your quick thoughts on like an update, I guess, just on the Treasury auctions. Like where are we stand? You kind of touch on that for a second. I know we've had some wild rides here the last 6 months or so. Where are we? Where do we kind of stand in that world right now?
Well, the Treasury has been really nimble at managing expectations on the street and how much debt they're going to be asking for, how much borrowing they're going to need. And so back in late last year, in November, we had a 30-year auction that was absolutely dismal. It was eye-opening. It was ugly, flat. And so the Treasury managed through that, changed expectations, managed expectations. That we're gonna manage the amount of debt that we have to issue here. It shored up the market. Auctions continued on kind of unabated. We had some soft auctions, some tailing auctions, which means that they trade beforehand in a when issued market. It's like pre auction, and if those prices are higher, meaning the interest rate is lower, then when the actual auction happens, it's not a good thing because expectations were better than reality. We've seen a bunch of tailing auctions. We had a 20-year auction about a month ago that was just awful. It was abysmal. It looked very much like the 30-year auction. It wasn't in any. I want to make it clear. It wasn't in any danger of failing, but it was a red flag to the Treasury on just how much demand there is for that duration, that was not encouraging.
Hmm.
So then we just had a 30-year treasury auction today. It wasn't that big, but again, it was fine. It went off without a hitch. It actually looked fine. It actually stopped through, meaning that the bids on the actual auction were better than the pre-auction, the prices paid.
Wow.
Um, so we're going to see. We're going to see here, Brandon, as we continue to spend money, as we continue to run these deficits, we're going to have to continue to borrow more and more. It's unclear exactly where the tax receipts are going to come in the next month. We'll see where that comes in, and just how much the Treasury has to issue over the second quarter. But I'm going to be watching these auctions carefully, because if you get into a period here where you've drawn down the reverse repo market, so you can't just keep issuing T-bills anymore. You've got to move further out on the yield curve, on the duration, and start issuing more 10-year, more 20-year, more 30-year treasuries. Well, that could present a problem. It could crimp on liquidity, especially as banks will, as their reserves wind down. They're over 3 trillion now. If they're down under 2.5 trillion, the Fed starts getting nervous. The Treasury starts getting nervous on these auctions. So we're gonna be watching that for sure.
Do you foresee, and part of this too, I guess, is social media. There's been a lot of talk about this lately as well. I mean, the government, the ruling class, they are very aware of, wait, whoa, these things are spreading. The bank crisis spread because of you people on social media, and they don't like Bitcoin, and they don't like social media because they don't like how fast word can spread, or being outed, or being called out, or whatever it is. It feels like it's going to be something to that effect, like a black swan, I guess you could call it in a way. But like, if there's some auctions that go no bid, or there's successive things that are happening, and then all of a sudden you have Bitcoiners, you have people that are in the know or paying attention, and they're like shouting from the rooftops, like, hey guys, this is not good. And then you see this spark, just like we saw a year ago with the banks, or it was a New York Community Bank. Now, I mean, things like that happening where it's like, whoa, 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 and just lights a fire.
Yeah, I mean that's definitely possible. And like, for instance, you would never have had so many people keyed in on Treasury auctions as you do now. If I post something on Treasury auctions, I mean, there's a lot of people watching that. Tens of thousands of people, hundreds of thousands
Wild.
are seeing those posts, and so that's not normal. That's not. But it's a new. It's a new normal.
Mm-hmm.
When
Yep.
I started on Wall Street, if you didn't have a Bloomberg terminal, you didn't know what happened in the Treasury auction.
Yeah.
Now you can just pull up on Twitter and you'll or X, and you'll see what happened in just minutes. So pull up Zero Hedge, or some often mine, and you'll see what happened. So um, yeah, so it is a different world we're living in for sure, and but that can also create opportunities because it creates outsized, unreasonable movements and volatility. And so, because of the herd mentality and just the sheer
Mm-hmm.
number of people coming into that trade, or into that event at that very moment, it often produces some. I would say it's an inefficiency.
Yeah. What what is the in transitioning here a little bit, Bitcoin Opportunity Fund and your newsletter, Informationist? I would love you to touch on these for a couple minutes, maybe for a minute or two, just seeing what you're, you guys getting to see, companies and things that are going on, some new technologies, whatever it might be in the Bitcoin space. To talk to us for a minute about each of these and kind of what you're working on here in those two spaces.
Yeah, so the Bitcoin Opportunity Fund we launched it this last year. We started investing over the fall, and it's a public-private partnership for accredited investors. And we're closed. We've already taken in all our investors for this fund, but we're super excited about how the capital raise went, and we've been investing along the way, especially because we were in a period of extreme pain with FTX and Celsius and all that. But what we do is we invest we see ourselves as deep value investors in the Bitcoin opportunity space, and we're looking for any opportunity. What's unique about us is because we're a public-private hedge fund, we can invest anywhere in the space. It's public, private, early stage, late stage. We can invest in stocks on the New York Stock Exchange, miners in the New York Stock Exchange. We can invest in private miners. We can invest in debt. We can use hedging strategies that perhaps the venture funds can't do. So it's a little
Mhm.
bit different in that way, in that we take the capital, we invest it, we start investing it right away. And then as we see opportunities in the private space, we're diligencing those and then making allocations to those. But we've had some super exciting investments. We're invested in a company in West Texas, Cormant, that is using stranded energy that is just stranded out in West Texas, and they're mining Bitcoin at a very
Wow.
attractive price and selling back to the grid when they want to, or when it's opportunistic. And that's it. We love investments like that because we can structure them in a way that we remain exposed to Bitcoin all the way along. And we've just partnered with Anchor Watch, you know, and that is that's Becca Rubenfeld's, and Rob's doing that one, and they're doing insurance for holders of Bitcoin and using Lloyd's of London to back them. And super exciting because
That's cool.
this is really important for especially something like a family office that does want to hold their own keys, but wants to make sure that they have a backstop there.
Yeah.
Especially if you're an investment advisor in a family office and you're not part of the family,
Yeah.
that's something you might look for. So we're super excited about that. And we've got some other private investments that we've done, and we're diligencing now, and we're and then of course in the public space we've done quite a few things, including volatility trading, volatility hedging on some of our positions, and investing in the miners. I won't name names because they're public companies, but yeah, it's been an exciting space. That was longer than a minute. Sorry. Um,
Yeah. You're all good.
and Bob Burnett is another guy that we've partnered with in
Yes.
the private side,
Sure.
doing some, as a lot of people know here. We've got a West Bay mining venture with him, and we're using stranded energy out in the Dakotas, and so that's been exciting. The Informationist is a newsletter I started a little over a year ago, and it's been great. I started it truly, Brandon, just to give people insight into what's going on in the world in my world of institutional
Hmm.
investing and how all these things work, but in a super simplistic way. So I try to simplify everything that anybody can understand. I've got anybody from nurses, firefighters, EMTs, lawyers. I've got chemical engineers, I've got professional dancers, I've got photographers. It's a wide range of interests and backgrounds there, and the common theme is that they're all interested in investing and interested in knowing all these things, but they were never taught them. I mean, none of us were, and they don't want to go read a textbook about it, but they want to know what these acronyms mean. When
Yeah.
the Fed does this, the BTFP, like what is that, and how
Yep.
does it work? Tell me in simple terms, and it's not like tell me like I'm five, but it's like tell me like I'm a super interested and curious person, but I have none of the financial terminology. Tell me that way. And so it's been great. It's grown over 30,000 subscribers now.
It's
Um,
amazing.
it's
Congrats.
free. You can find it on jameslavish.com
Yeah,
and
we'll
just
link
sign
to
up.
it. It's
It comes out
amazing.
every Sunday. Well, thank you. I appreciate that. I've gotten great
No.
feedback. We have an awesome community there. So
Is
yeah,
it just you writing it and doing everything for it?
I'm a one man show.
That's amazing. It is. It's phenomenal. It is
Thank you.
one of the better ones. I'll say better just to be conservative, I guess, but it's one of the better ones out there. It really is.
Thank you.
It's really good. So we'll link
I
to it and stuff. So
really
yeah,
appreciate that. Yeah. Yeah.
absolutely. All right, so we got to play a quick word association game here in a minute, but really
Okay.
quickly, the brief story of hockey again. That's for anyone that knows. we both played college hockey. I played Michigan State. James played at Yale, and
Not against
then
each
not against each
other.
other. Yeah, we're a couple years apart, but have a background in that space, and it's cool to see more people coming in from athletics and different world into Bitcoin. So give me the brief kind of overview for the people, just what that was like, and just kind of the lessons you kind of learned from that, just to where you are now.
Yeah, I mean, look, when I was in high school, I was playing a number of sports. I was playing soccer, baseball, hockey, and as we did when we were kids, you
Yeah.
guys didn't. But when I was a kid, you played everything, and I didn't really commit to hockey until I was about a junior.
Wow.
But senior year, I grew a lot. I had some really good games, and I got noticed by the Boston Bruins scouts. And so, at one of the summer games out in Boston, we played in leagues out there. You may remember Hockey Night in Boston, that stuff. And I got noticed
Mm-hmm.
out there in a different league, but and so. They drafted me when I was 18, and as you know, and for your listeners, in hockey, you get drafted at 18 and then you go off to university, and the team that drafted you basically owns your rights for 4 years, and then they have to decide what to do. And so I went and I played at Yale, and was doing great. Everything was awesome. My line, I was fortunate to be on a line with the all-time leading scorer for Yale all-time history, Mark Kaufman. He was a phenomenal player, and basically, I was super fortunate to be on the line with him and some of the best players in the whole league. We had a number of All-Americans on that line, and so uh, everything's going great. It's awesome. I'm on the U.S. national team, trying out for the Olympics, and senior year, I I take one hit. It's just a regular game playing against St. Lawrence, and was taking a puck out of the zone. I got hit the wrong way. My knee popped, and I tore my ligaments, and I basically just didn't recover from that. It was
Wow.
terrible timing, and I was like I was on my way. I was 100% sure I was going to be signed by the Bruins. I couldn't have an agent yet, but I was talking to
Yeah.
agents, and they were kind of edging in to figure out.
Giving you the scoop. Yeah.
Yeah, and I mean, I wasn't the best one on the team, but I was one of the guys that had high potential to go.
Mm-hmm.
And so as a senior, and it was just like that. It was over in a flash. And I made the tough decision. To be truthful, I made the tough decision. I wasn't going to be the guy who's just going to splash into the NHL and be a starter. I would have had to grind it out in the AHL or whatever for a little
Yep.
bit, even if I was perfectly healthy. But I went to New York Rangers camp, and Mark Messier was there. These are long stories, so we'll have to have another podcast about
Yeah.
this. But
Cool.
and I tried. I tried, but I wasn't there. I wasn't healthy enough, and I was like, this is going to take me years to get back to where I was. And I just graduated Yale, and I was like, I need
Yeah.
money. I don't. I knew in my heart that it was going to take too long to get there, and I wasn't sure if I would ever get back to 100%. I mean, my knee was shattered.
Jeez.
And back then, we didn't have the kind of surgeries you do now, where
Yeah.
you have an ACL blowout, you're back on the field or back on
Yeah.
the ice in less than a year. I mean, I would have been back on the ice in a year, but it would have been a long anyway.
Yeah.
So I decided, made the tough decision that I was going to have to pivot and talk to some of my friends, hockey players who were on Wall Street, and they said, "You got to see
Mhm.
what we do." And they introduced
Wow.
me to a bunch of people, and I got hired to be a clerk on the floor of the New York Stock Exchange. Getting coffee and
Wow.
tuna fish sandwiches for the brokers.
That's
But
amazing.
my first job was, I mean, honestly, it was because I was pretty good at math. It was trading ADR arbitrage on the floor of the stock exchange. So, which is basically just trading the arbitrage between foreign shares and domestic shares that trade on between London or Europe or Asia or Mexico on the floor. So, yeah, it was pretty
Wow.
wild.
Well, next
So
time
that's how I
we
landed.
are,
I got drafted by the Boston. I landed on Wall Street.
yeah, there you go. Next time, yeah, like you said, we'll maybe in person or whatever it is, maybe a few months when we do it on here. If next conference, we're gonna do a hockey stories pod for sit down for 30 minutes and just we'll share stories and record it because that's that's how
That's
in the beginning a year and a half ago was we had some very similar stories. Played for the U.S. national team, got really hurt when I was 18 years old, and I played for a handful of years still, but had to make that tough decision of like, yeah,
you
this
know it.
I just
Yeah.
yeah, it's
Yeah.
crazy.
But
So
once you get injured like that in hockey, we've seen it in the pros. You see some of the guys they're
yes,
just never the same because it's such a physical game. Um,
yes,
I mean, you see it in football.
oh yeah,
Often you just,
yep,
if you get hurt in football, often you're just knocked out. So,
yep,
but you don't see people like Tony Romo recovering from a back injury. I mean, like it's tough.
right,
These games are,
very few, yeah,
they're physical. They're really physical, but um, it was awesome. I loved it. I'm thankful for it. It definitely set me on the right path. It did. And going to your initial question, which is really important, I do believe it kept me on the rails. And as far as
mhm,
uh, just learning that grit, that determination, that sheer determination and tenacity to go after what I wanted and have the discipline to do it in a way that got me there. And hockey players they're typically uh, pretty humble and low key.
yeah,
They don't dance around. You'll get your head chopped off if you do. So
true,
so it keeps you grounded, and it has. I'm definitely way more grounded today than I was when I was a 21-year-old high flying kid. But I got grounded pretty quickly after that injury. I'll tell you that much. So, yeah,
humbling,
life is strange, but you just pivot and you do it. You just keep going. That's what we do.
yeah, yeah. It's a great lesson. Such a great lesson. All right, last segment presented by gonna grab them. Bitcoin trading cards.
All
So our
right.
podcast
Oh,
here
yeah.
presented by Bitcoin trading cards, orange pilling the world, a new segment presented by Bitcoin trading cards, word
Sweet.
association. So we're gonna do word association this time. Got a list of words, just rattle them off, whatever's in your head, and then
Okay.
we'll end this bad boy. The Bitcoin ETFs,
Oh, money.
hyper Bitcoinization,
Soon.
Michael Saylor,
Oh, genius.
Sam Bankman-Fried,
Fraud.
politics,
Lies.
wizards,
Harry Potter.
banks,
Ah. Cantillon.
ooh, women in Bitcoin.
Needed.
Like that. Bitcoin conferences,
It's stimulating.
community,
Oh, strength.
Janet Yellen,
Retire.
Jerome Powell.
Should be retired. Oh, sorry, one word. You
Yeah.
know what? Honestly, the word that really does come into mind for Powell is pickle.
Oh, I thought you might actually go that route. I love that. I didn't think of that word though. I love that. I thought you were going to say like stuck or something. I love that.
Yeah.
Um, debt spiral.
In it.
Ben Bernanke.
uh, I would say over. What's the word I'm looking for? There's a word I'm looking for. Over revered.
Ooh, I like that. Bitcoin trading cards.
Uh, I, classic is the word that comes in my mind, but that's it.
Love that. Bitcoin Opportunity Fund.
Opportunity.
The Informationist.
Simple.
Love that. James, thank you so much. Appreciate you, brother. Thank you for coming on today. It was an absolute
Yeah, of
blast.
course. It was fun. Yeah.
Good. Yeah, I've got some good feedback over this past week. I just started doing this week. Svetsky was like dying too. He was like, "This is hilarious." So I appreciate you coming on, and look forward to doing it again soon. Seeing you soon, and appreciate you being a playable character, because boy, do we need more of them. Thanks, brother.
Yeah, of course. It's a pleasure to be here, Brandon. I look forward to talking about hockey sometime soon.
Absolutely. And where can people find you? Lastly.
Obviously on Twitter, I'm just James Lavish. The Informationist is at just jameslavish.com. There's a link in my Twitter bio. And if you're interested in being on the list for future Bitcoin opportunity funds or investments, then you can email us there at bitcoinopportunity.fund. Just go on, it's www.bitcoinopportunity.fund and sign up and attest that you're accredited investor, and we can send you information. So
Beautiful. Thank you, sir. I appreciate you.
awesome. See you next time.
Thank you for checking out this episode of the Playable Characters Show, brought to you by Bitcoin Trading Cards. Make sure to subscribe so you don't miss any of the future Bitcoin and financial experts we have on the show. Plus, we will be doing random big giveaways throughout different moments of shows of collectible cards, sats, merch, and more from guests, so you won't miss anything. This show does not constitute any investment advice, only freedom advice. Everything you see here is opinions from the host and the guests themselves, nothing further. Please don't trust, verify. For full transparency, I do lead marketing efforts at Bitcoin Trading Cards, where we are trying to spread freedom to all of humanity and orange pill the world, one collectible physical trading card at a time, by making things fun and easy to talk about that normally make you want to cry. You can reach me directly through my email, brandon@btc-cards.com, with any inquiries or playable character suggestions. See you on the next one.